Good morning, everyone. A warm welcome to the suburb of London, Shirley, from my living room. My name is Gunnar Larsen. You are today tuned into a briefing on COVID-19, Brexit, and the continued disruption of the world order. An economic update on 2020. A lot of things has happened. So on behalf of all the Nordic Chambers of Commerce, the British Icelandic, Norwegian British and Finnish British Chambers of Commerce, as well as the Danish-UK Association, I welcome you to this session where we will be discussing and hearing about what's going on and the latest observations. We have a great panel with a strong support from Danske Bank that will give us an insight to this. Just a few house rules. Any questions, you can already now add the questions in the question box that you have on your screen. I will take them through at the end, curate them. You also have a chat function here. On the chat function, I will recommend you just maybe now say, where are you? How is it going? What are your comments to anything that's being said, maybe during the session here today? But otherwise, the chat functions is not for questions. I may miss them because there could well be a lot more things going on in the chat. I should also say that this presentation here today is being recorded and will be shared with all of you shortly after, a couple of hours after, by email. So do look out for the emails. I am aware that some of you may have very strong firewalls. For example, Danske Bank, you have a number of colleagues there. So because you are so many people from certain companies, your firewalls may prevent you, in which case do get in touch and we will try to share the recording with you directly afterwards. I think that was really some of the main house rules I would like to kick off with. To start also, we would like to maybe start with a poll, just to get a bit of a feel for what is the sentiment at the moment. I'm going to start a poll now that will be visible on your screen. It's basically, in the light of the COVID-19, do you think Brexit will place the UK in a better or worse position for economic recovery relatively to the EU 27? So at the moment, you'll see the poll on your screen, and I would like to take a moment to answer to the best that you can. And I'm going to leave the poll open for a few minutes, and then I'll come back and show you the result later. So even though it's no longer on the screen, you'll find it still up in the upper right corner of your screen, and you can enter the response that you may have to it. And I will then shortly be closing the poll again and show the result later. And with that, I think we are ready to get started. And I'm going to zoom in on the first speaker we have today, Allen von Meeren, Chief Analyst of Danske Bank, based in Copenhagen, I believe. Allen has worked with global macro and financial markets for more than 20 years and has over the past 5 years had a special focus on China. He has been with Danske Bank since 2007. Over the past 2 years, he has followed the US-China trade war and decoupling of the two superpowers closely, and recently undertaken research on the COVID-19 deployment. And so very, very qualified to be in this room today. He will be talking on global macro, COVID-19 effect, and geopolitical changes. So with that, Allen, can I ask you to take the word from here, please?
Absolutely. Good morning from me, and welcome to everyone. So as Gunnar just mentioned, I will take a brief look on the COVID-19, where we are with that in Europe, US, the rest of the world. Talk a little bit about how we see the global macro outlook, and then dive into some of the geopolitical changes we see at the moment, especially with rising tensions between the US and China, and maybe the beginning of a new kind of a Cold War. But let me start with update on the virus. What you can see on your screen now is the development in new infections of the COVID-19 in different regions. And the good news is that when we look at Europe, there's been a lot of improvement. And as you know, the reopening have begun, and we start to see already some positive economic effects of that. So that's good. And so far, despite we've had this reopening, there hasn't really been any new flare-up in the virus, which have been feared. So far, so good for Europe. When we look at the US, it seems like, we haven't gotten the same improvement in the US, but the US have been maybe more impatient with opening up, and there's been a lot of opposition towards the lockdowns. So we are seeing the opening up also in the US. And maybe the positive thing in the US, at least, is that we haven't seen a flare-up in the virus after the reopening there either. And also, despite these protests that we're seeing across the US now, which could give a risk of new increases, I think so far it doesn't seem to be the case. We still need to watch it in the coming weeks, but at least for now, it looks like at least we're not getting a second wave. When we look to the rest of the world, the emerging markets, some developing countries, the picture is not that bright. So you can see here, especially Latin America have seen big increases. It's Mexico, it's Brazil, Chile, Peru, that are some of the countries that are really struggling there. And in emerging Asia also, we've seen in India, Bangladesh, some other countries that the virus is really not under control and still rising. But overall, at least when we look at Europe and the US, the reopening of the economy is ongoing, and that leads us to have some optimism that the economic recovery that we have been looking for is starting to take place. If we look at our forecast for the global economy, you can see here on the screen to the left-hand side, we've had a very, very sharp decline in Q1. Q2 is more or less flat, but that's based on that China we expect to see a rebound in China from this very, very low level, whereas Europe and US is likely to see a further drop in Q2. And then when we look into the second half, we do expect to see some gradual recovery from this very deep recession we're in right now. And as I mentioned, we do actually already see some signs that the consumers are coming back to the shops. We see signs that mobility is coming back, and so there are some encouraging signs, and that's also what we see in financial markets at the moment, that there's definitely better sentiment and hope. And also when we look at what's happening on the medical front in terms of the virus, we have seen some good news in terms of vaccines that are already heading into phase 2 trials, phase 3 trials. And the most optimistic forecast right now is that potentially a vaccine could be ready already in 6 months' time, which of course would mean that when we have a vaccine, it will be time to be able to put this virus behind us and look forward again. So these slightly encouraging news have given somewhat more optimism, and it can kind of become self-fulfilling if we get a little bit more optimism, people dare to spend again and invest again. But as you can also see on this chart, we do expect we don't expect to get back to the old trend. We do expect that tourism, for example, will still be hit and be weaker than before the crisis for some time. Some sectors will be still below the old trend. Others will probably gain, but overall we think that it's not likely we will get completely back to the old trend. In terms of growth rates, we see very negative growth rates in 2020, and then because of this catching up, we're having actually quite high growth rates in 2021. So now I'm going to shift gear a little bit and look at the development in the world order, especially focusing on US and China. And beginning of the year, we had this phase 1 trade deal. Things were starting to look a little bit better between US and China, but this COVID-19 crisis have really taken a sharp turn for the worse in US-China relations after things really got bad in the US. Up until late February, actually, Trump was praising China, said China was making a lot of progress and saying that the relationship with China is very good. And also that they have been talking to the Chinese people and coordinating what's going on with the virus. That was in late February. And then we just had to move 1 month later. And then, of course, the virus really starts to take hold in the US, and the relationship really deteriorates very sharply. So Trump starting to talk about the plague from China, threatening first to pull out of WHO, and then finally actually doing it. We have the Mike Pompeo, the Secretary of Foreign Affairs, talking about enormous evidence that this is coming from a lab in Wuhan. So this is really sharp language and accusations. So far, there hasn't been any evidence presented of this, but definitely, the tone has become very sharp between the two countries. And it's not only the virus; it's just adding to the tensions that were already there. And in May, we saw a new attack in the tech war on Huawei. I'll get back to that in a minute. But also in Hong Kong, with this security law from China in Hong Kong has really added to tensions. We have Trump starting to question whether the trade deal will continue or not. So the uncertainty around that has come back. We see rising tensions in the South China Sea. We see the US challenging this one China policy more and more when it comes to Taiwan. So really on all fronts now, it's a lot of confrontation between the two countries. So what is really behind this very sharp deterioration, basically since Trump came to power? Well, I think several things, but I think the biggest underlying thing is that it looks like China could become a new very big superpower. When we look at GDP, China today is around 70%. When we look at nominal GDP, 70% of the US level. But if we fast forward 30 years out, potentially China's economy could be double the size of the US. It may sound maybe quite optimistic on China's behalf, but we have to just keep in mind that China is 4 times more people than the US. So what it would require is really that China reaches GDP level per capita that is only 50% of the US level. Then basically China would become double the size because the population is 4 times bigger. And of course, this is a huge threat to US power. It means that China is going to gain power, and the two systems are very different, with the US being this focus on freedom, human rights, democracy, and China really saying, no, we want to stick on our own path. China believes their own path is more efficient. They can make more progress, and that democracy in China would lead to chaos and instability, like we saw in the Soviet Union or Russia when the Communist Party fell from power there. So really nothing to suggest that China is going to change path, and that means that we are likely to see this rivalry only continue in the coming years. As I mentioned just before, the US have launched a very sharp attack on Huawei, this huge tele-equipment company in China, one of the big success stories seen from China's point of view. So what is this attack? Well, basically, Huawei can no longer buy any chip product, so semiconductors, from any company in the world that is using any US technology, any US design. That basically means that China of Huawei will not be able to buy semiconductors from any company, more or less, because all semiconductor technology is based on either American production technology or design, or some sort of American origin. And that's part of the global supply chains, that you have, different components, from different countries. But the US is now using this to really block access to semiconductors for Huawei. Steve Bannon, as you know, is the most right-wing maybe in the US, but he's basically saying killing Huawei is more important than the trade deal with China. And it does seem like that the strategy now is to really kill Huawei. And that's, of course, a huge attack also on China's rise. I think China has so far not really retaliated. China will be careful, I think, not to provoke the US too much, because the US does have the upper hand here. But there are other ways where China can retaliate and make the US pay a price for this. But this, I think, is just really the biggest symbol we have right now of how far this deterioration has come already. So to sum up a bit, where are we now following this virus development that is only added to this? I mean, the narrative now in the US is China is a threat. It's gaining strength in the US population, and most people in the US now definitely support this, that China is a threat. And it's not likely that any American president can be elected without taking a very tough stance on China, either at the coming election or future elections. So that's I think is where we're heading. The US is really in a long-term fight to counter the Chinese Communist Party. It's been very clear about that it's not after China, but it's the Communist Party it's after. So very much like the Cold War with the Soviet Union and the Communist Party there. And if Biden should win the election, which at the moment at least it looks like, he will be working more on building alliances with the US allies, so Europe, Japan, South Korea, other nations where they will try to build an alliance to confront China. So pretty a little bit dire outlook for this relationship here. And on the Chinese side, when you see the Chinese state media at the moment, they're really highlighting this mess that the US is in their eyes, in terms of a very high death rate, very high level of infections. And now you have the protests in the US, which for China is a symbol of the failure of US capitalism, where the vulnerable is not having a priority, and their votes don't matter if they vote at all. And that is to Chinese Communist Party, in contrast with their focus on poverty, reducing inequality, which they have put at the top of their agenda. It also means that it's a China under attack. That is how they see it, and that means that probably control censorship security is not going to improve. It's only going to mean even more control, as we see in Hong Kong right now. So I think, just to sum up, I mean, we see somewhat more positive outlook for the global economy. But when we look towards the relationship and global order in the future between US and China, and that will put other regions in a dilemma, a little bit being squeezed between US and China. So I think that's what we can expect for the coming years. So yeah, not too optimistic on this front, unfortunately, but at least more optimistic on the economic outlook here in the short term. Thank you. That was all from me.
Gunnar, we can't hear you.
Thank you very much. Some good input from Alan, and let me see if I can get the technology to work rightly. Thanks for the comment there. Let me show the results of the first poll here now, just to give an idea of how people saw it. So the question again was, in the light of COVID-19, do you think Brexit will place the UK in a better or worse position for economy recovery relatively to the EU 27? And I think it's pretty clear from this one, at least, that majority would say it would be worse. There will be More polls coming up, so stay tuned. And again, this is not a scientific poll, but really just on the sentiment from this room. Moving on, I could maybe just also here, please remind people on for any questions that you have, do enter them as we go along, and I'll curate them at the end, and I can bring the question up on the room. So take a moment. There's a slight delay of about 20-30 seconds from when you enter the question till it comes through. So better put the question in sooner rather than later, or you may be too late at the end. So moving on, I would here like to introduce the next speaker, and some of you may recognize her because we had the pleasure of seeing Christine Tuxen at an event last year hosted by Danske Bank, where we had an update on the FX market as well. Christine is a chief analyst and head of FX research at Danske Bank. Christine is specializing in the G10 currencies and has quantitative FX models as her primary focus. She holds a PhD in applied econometrics from the University of Copenhagen. Prior to joining Danske Bank, she was with the Global Economics Research Team at Lehman Brothers in London and did research stints at both the Danish Central Bank and the Bank of England. So she is here today, and she will speak about global FX, financial markets in the light of recent and current disruptions. And with that, Christine, can I ask you to unmute yourself and take the word from here, please?
Yes, thanks a lot, Gunnar, and thanks everybody for joining this morning. Yeah, so I'll try to take you in a good 10 minutes through our key views on the currency markets, which are, as Gunnar said, the ones that me and my team that we follow very closely. I will of course focus on outlook for sterling against euro and the dollar because I reckon that that will be where many of you have your currency exposures. But also do let me know or post questions on some other currencies if you want me to go into some of these towards the end. I think we will actually just start with a poll, Gunnar. I would like to ask the audience here how you see sterling against dollar in 1 year's time relative to today. So I posted here 3 different options. Is it broadly unchanged around the current spot? It's actually moved a little bit higher today, but close to 127 and a half now. Would you see that level persisting, or are you expecting sterling to go higher or lower against the dollar? So just take a time to of a few seconds to consider that, and then of course I will give you obviously our answer to that question or view on where we might be going towards the end. I think if we go to the first slide, where I've just posted a brief overview. If we go to the next one, Gunnar, yeah. Just to give you a very, very top-down view on FX markets. So I think if we're looking around currency markets right now, you know, we are in a situation right now where markets are, and that goes actually not just for currency markets, but for credit, equity, and rates markets as well. We are balancing a little bit these very smooth reopenings that we are seeing, which are being supported by quite extensive stimulus from both monetary and fiscal policymakers, against the risks that notably Alan talked about, namely that of geopolitical tensions, such as the ones between US and China flaring up, and also, you know, what exactly is going to be the fallout of this recession that the COVID shock has led to. Will we see a series of bankruptcies? Will we see global supply chains being disrupted? Or what is going to be the fallout medium term, I think. But for now, that does not really seem to be where the market is focusing. Even the US-China issue is not really something that has managed to steer any clear direction, at least in the FX market. And I think to a very large extent, for now, it seems that investors are really comfortable that with all the policy stimulus we've gotten from the US, from the Euro side, from across notably some of the major economies, that is actually going to be quite enough to get us decently through this recession. Of course, we can talk about some of the risks around that, but notably, I think what investors are starting to gear up to, and that's also some of the questions I'll try to give you a first answer to, or try to at least, is whether we will see this corona crisis lead to a reflationary shock. You can say in itself, The fact that we are entering a global recession is in itself something that depress prices, is deflationary. But because of the massive stimulus and potentially some of the regime shifts we've seen there from policymakers reacting very forcefully in a very short time span, that is something that has started to form a reflation or inflationary shift, at least as a tactical theme on investors' behalf. And I think the reason I mention it here, you can say basically the key question here is this now the time where we are finally going to see inflation grab hold again? Remember, that was really the big struggle for notably central banks in the aftermath of the global financial crisis. If we are in a situation where inflation will now actually start to surge on some of all the stimulus we've gotten, then that could actually mean an end to what we would say, and most people will probably agree there, is a very strong dollar relative to fundamentals, relative to where we've been historically. That's a quite key question. We don't have a very definite answer to that just yet, but we are not necessarily so sure as many others that we are heading for reflation or a great pickup in inflation on a global scale. So I'll come back to that a little bit when we are going to discuss risks around our dollar view. I'll of course speak a little bit about sterling and Brexit, if you bear with me there, and then I'll delve more at notably the dollar and euro outlook against sterling, but of course also the Scandinavian currencies. Very happy to discuss those, and I reckon that many of you will not be too interested in some of the more safe haven like ones like the Swiss franc and yen, so I've actually left them out in this presentation here. But if we go to the next slide, and there might be a slight overlap here with some of the things Alan said, but I just like to just pinpoint how this crisis response on behalf of policymakers have been significantly different from what we saw in the aftermath of the global financial crisis, because that also means a lot in terms of what we are basing our FX outlook upon. And I've basically listed here on the top panel 3 different pillars that I'd like to just form your views around, or how to think of the policy response we've got. We've got policy rate cuts where that was actually possible. As you will know, now we are discussing whether we will see negative in the UK, but a lot of central banks are not too happy about negative rates. And it's still a debate whether it's actually counterproductive to have negative rates. But notably where it was possible, for example, in Norway and some EM countries, policy rates were of course cut. It's the first line of defense for most central banks usually. But of course, also given the nature of the crisis, one of the things that was very key for central banks to do was to provide liquidity, of course, in cooperation with governments. And hence we have seen these rising central bank balances. That's the middle panel there in the slide, where notably the Fed was quite aggressive and very fast, quickly so, in upping its liquidity provision to the banking system. And then we've also seen, and that's probably notably in Europe, where we've seen the biggest change compared to previous crises, namely this willingness to spend also on behalf of the government and basically issue debt to do so. There have both been outright spending, which has been quite significant in the US, but there's of course also been credit provisions. So basically, of course, liquidity arrangements to bridge the fallout in activity that lockdowns have caused. Germany has, of course, recently announced even more, and it's probably the more interesting one within the EU, given that the EU pillars here are not looking too great in necessarily in comparison with the US, but certainly a regime shift in the EU context, also around this the construction of a recovery fund. So it's just to basically pinpoint that even if we've seen a significant drop in here global activity on the manufacturing side measured by the purchasing managers indices, we've actually also seen a very forceful policy response. So maybe that's a very long way of saying that. So that makes us hopeful, and that was also what Alan was alluding to in terms of getting a recovery in the second half of the year. But if we go to the next slide, Yeah, it's just to very briefly also mention that some of the things that we have been looking at as Danske Bank has actually been using our own transaction data on an aggregate level to see for the Scandinavian countries, and notably here I'm showing you Danish consumers, how much they have been spending on transaction cards. And you can see there's a gray bar here because of the Easter timing makes things difficult to predict in or to compare in just that period. But it's actually quite remarkable how significant you can say consumer spending dropped in face of lockdowns, but also notably, of course, looking ahead, how quickly it actually came back when the lockdowns were eased. And if we go to the next slide, we can see a little bit a similar story when we look at the US situation, where our US economist is looking a lot at these Google and Apple mobility data, where we are clearly not back to normal in terms of activity. But certainly we are starting to see that also, at a very micro level, citizens or consumer behavior is starting to come back to pre-corona lockdown levels, and that of course makes us optimistic for the outlook going forward. But more into the FX specifics. If we go to the next slide, then I think one of the key legacies from the corona crisis is that we might have a shift in what we call natural rates between the EU or the European area and the US. It's not at all clear in what direction this shift is gonna go, but given that we have seen historically that there's been a drift lower in where the equilibrium weight for interests belong in Europe relative to the US. We are basically just reminding ourselves that longer term, if we end up with a situation where the US is more flexible, both in terms of policy, but also more from an institutional side, if that makes for a more productive U.S. economy longer term relative to Europe, it's not clear cut that that's where we are going. Then we could actually see this medium term trend in the spread between where interest rates should be in Euroland relative to the US extend, and that would, everything else equal, mean that we will still have a downward pressure on euro-dollar. It's a long discussion to go into all the details of what could drive this and so on, but it's just we are alluding to a little bit here that whoever arrives the most productively from this crisis, given choices made by governments and policymakers more broadly, will be pretty important for the direction for the dollar. Now, of course, here against the euro, but some of the same arguments could be made against sterling. That's one of the legacies where you can say we don't have a clear-cut view on where we are going here. We have an indication that it might not necessarily be a longer-term positive for the eurozone. So that's one legacy that I would highlight in an FX context. And if we go to the next slide, another legacy is that, there's a lot of numbers in this chart here. I would basically just circle out that one of the things that we are rising from this crisis with is a dollar that until at least a few weeks back was at a historically strong level. It's also overvalued, both when we look at, if you just look at the top line and look at the correction potential, for example, in sterling and cable sterling against dollar, you can say both when we look at PPP, so these very long-term valuation metrics, purchasing power parity, and also our more medium-term valuation models, then there is certainly a potential for the dollar to sell off. That goes not only against sterling, but against a range of other currencies. Fundamentals have not changed much, apart from potential natural rate shifts that I mentioned before. But we are still at a situation where longer term, our bias would be for sterling to start to recover somewhat. We'll come back to that in a Brexit context in a second. But because we've seen some spot moves that have just tended to make the dollar more overvalued during this crisis, that is one of the factors that I would just highlight as one of the other legacies from the corona crisis, just to have in the back of your mind when we specifically talk about the outlook for the next 1 year or so. a lot will hinge on whether we will see, as I said in the beginning, the U.S. Central Bank, the Fed being willing to create inflation, because that way around, that would probably be the key trigger to debase the dollar and correct this long-standing dollar overvaluation that has only been aggravated by the Corona crisis, basically. But if you go to the next slide and delve a little bit more into to some of the, I think we might actually just very briefly conclude from this slide here that we've had a range of different initiatives from both monetary and fiscal policymakers, which basically means that some of the institutional risks that you might have worried about in the Eurozone, that they have been taken out, and that has basically fostered a level shift in Eurodollar. So that's probably one of the reasons, or it is one of the reasons in our view, that we've seen the dollar weaken on a broader note, not only against the euro actually, in the past couple of weeks. Now we are starting, if we go to the next slide, to see more like a US factor forming. We see US labor markets recovering much faster than expected. If any of you saw the job report on Friday, you will know that that was a massive surprise to analysts, but also to the market. And that has just made optimism, the positive risk sentiment that notably is, of course, feeding through to equity markets. It just sustained that to an even greater extent. Of course, there can be issues around whether we can interpret these numbers, but at least in the way we usually can, and unemployment rates are still high. We're still seeing a permanent rise, or a rise in permanent layoffs. So it's not that we are just out of the woods yet necessarily, but clearly a positive surprise here that the US might actually start to be a positive factor going forward, of course, depending also on how the virus situation continues to evolve. That does not necessarily mean that we will have a stronger dollar on the back of this. It all depends on what the Fed is going to do. And by the way, they have their meeting tonight, and we don't think that they will actually start to withdraw any stimulus on the back of numbers like this. They will want to see the recovery gain more hold, and notably also allow some inflation to get going. Alan was mentioning, of course, Trump and the trade war. I think a key factor as to whether we could see pockets of dollar strength into the November election will be whether the China-US trade war is flaring up again. If we have tariffs imposed on China, it is basically a terms of trade improvement on behalf of the US and hence on the dollar, and that can deliver pockets of dollar strength from that angle. So that is a factor to watch. But if we go to the next slide and heading to some key factors to watch out for longer term, I've mentioned the inflation outlook. To the right, you can say historically the US has been better at creating inflation. And as I said, if the Fed decides to debase the dollar because they have a preference for creating inflation, and now have the tools, or they have imposed this extensive stimulus that could allow them to do so, that is a key negative for the dollar going forward. But our sort of bias would probably be towards that the dollar positives will still be dominating, and that's what I've been alluding to here to the left, where if you look at the broad nominal dollar, so the dollar against a range of currencies, including sterling, but also the euro, if you look at how US equity markets have performed relative to the rest of the world, that's basically the blue line, where the broad dollar is the red line, you can see that over the past 10 years, we have seen that US equities have just been more sought after than the general stock market. And that tells us that there is, you can maybe say that anecdotally as well, evidence that investors have a preference for the technology exposure that the US represents equity-wise. And you know, our take would probably be that we are not in a tech bubble, and that this preference for technology can actually last. And that means that even if we don't have a rate differential argument, a carry argument for investors in terms of buying the dollar assets these days. Remember, the carry trade was something that really held a hand under the dollar in recent years. Then we actually have potentially a relative equity story that will still be dollar positive. So that is basically where I will end. If we go to the next slide, the dollar discussion here, I could say I won't say too much in terms of all the different Brexit deadlines. You probably know these better than me. What then about sterling? Of course, I've talked more generally about the dollar here. Well, we think actually near term that sterling is underpricing the Brexit, the risks of a no trade deal. And of course, there is the deadline on the 1st of July for the UK to seek an extension. There's also some issues around finding an agreement on finance and fishery, and we actually think that that Johnson will, as he has said, he won't seek that extension, and then we will actually be in a situation where the UK, but also markets, will have to start the no deal planning. In the end, it will probably be a similar situation as we had with the divorce or withdrawal agreement, that last minute, maybe in late autumn, we will still see some kind of simple free trade agreement being reached, and then we'll have a ratification process. But in the coming few months into the summer, we think that on Brexit risk will have to be priced in again in sterling. We actually see 35% for what these probabilities are worth, that the UK will end on WTO terms on the 1st of January. So of course businesses should prepare for that. So euro sterling could probably go to 92, I think, in Q3. That's our call at least for now. So I think if we go to the next slide and just round it off here, I'm giving you basically our answer here to where cable will be trading in 12 months' time. It's the upper right-hand side corner there, the 129. And of course, I would be eager to see, Gunnar, what our audience have been calling for ahead of my talk here.
Let me reveal the answer there.
Okay, so most actually think it would be lower. So quite sterling bearish, but also some dispersion, I guess. And you can say broadly unchanged from here is actually not too far from our 129, even if we probably would fit into the category of slightly higher. So that's interesting. And I guess that also rhymes well with the initial poll you had, that the UK would leave would be worse off due to Brexit arising from the corona shock. So
yeah.
So yeah, I think that's all from my side for now.
Very good, Christine. Thank you very much. Very thorough. And let's move on right away to introduce you to the next speaker. We have Conor Lamb, Chief Economist from the Danske Bank Northern Ireland, on this webinar as well. Conor is responsible for Danske Bank's Northern Ireland quarterly sectorial forecast and Northern Ireland Consumer Confidence Index, and is a regular contributor across the Belfast media. He often speaks at business functions with Danske Bank customers, focusing on his perspective around the global UK and Northern Ireland economies. Most recently, he has been sharing his insights on the economic impact of COVID-19 and Brexit. Today, he's going to be speaking about the UK economy and Brexit specifically. So with that, Conor, can I leave it with you, please? Can you hear us, Conor?
Thank you very much, Gunnar, and good morning, everyone. Just like to add to everybody for joining us today. I've had a few technical issues this morning, so Gunnar is going to help me with my slides, so you'll have to forgive me. I'll have to ask him at which stage to click through those, but hopefully it'll run okay. So this morning I'm going to speak about the outlook for the UK economy and Brexit. And specifically I'm going to focus on three areas. I'm going to begin by talking about the impacts that COVID-19 has had and is having on the UK economy. I'm then going to move on to speaking about the outlook for economic growth in the UK, how quickly we see economic activity recover pre-coronavirus, and discuss the Brexit process and some of the key deadlines to be aware of, but also just some of the issues that we're seeing appearing in the Brexit negotiations at the minute. So again, by taking a look at UK GDP growth in the first quarter of this year. So Gunnar, if we can just, thank you. So what I think is striking we've seen is that the UK economy contracted by 2% quarter on quarter in first of 2020. And I think the important thing to note here is that this was the sharpest fall in the UK economy since during the global financial crisis. But yet the lockdown measures that we've used to living with really only came into effect in the last week or so of March. Now, we know that a number of businesses perhaps started to slow down activity, and some of them may even have closed on a voluntary basis themselves in the run-up to that date. But even though it was such a limited period of time with which the economy was effectively shut down, it's had a large impact on the GDP numbers for the whole quarter. But unfortunately, this is just a very small contraction compared to what I think we're going to see in Q2, when the true impacts of the lockdown begin to actually be felt. Now, if we move on to some more timely numbers, the ONS in the UK, to try and give us a better measure of what's happening in the economy, have been running business surveys during the lockdown period. And their most recent survey covered the first couple of weeks of May. And what it showed us is, Gunnar, if we can move to the next slide, please. What it showed us is the way that turnover has been impacted different industries in the UK. And I think the first point I would make that just shows the extent to which this impacted businesses throughout the country is that across all industries, firms have seen, or about 60% of firms have seen turnover decline. So the blue bars in this show the businesses, the percentage of businesses reporting a turnover decrease of more than 50%. The red bar is a turnover decrease of up to 50%. Now, as you may expect, some of the industries most impacted by lockdown have been those consumer-focused sectors, entertainment businesses, and accommodation and food services, the likes of restaurants and hotels, and also the construction sector as well, where a lot of activity closed down in the early part of April. But I think just the fact that so many businesses are reporting such large increases in turnover is just a signal of the extent to which the economy has grown to a halt as a result of the lockdown measures. If we move on to the next slide, then there's a couple of points which I want to make about what's happening now in the economy that will be important drivers of the recovery that we see. And the first relates to the cash reserves held by a number of businesses in the UK. So what we are able to see is many firms actually only have cash reserves that will last them for up to a period of 6 months. And it's smaller businesses who have those smaller cash reserves, which means that they're perhaps more vulnerable than some of the larger companies to ride through this crisis. And that's in line with what we would expect. I think what's also interesting in this chart is the proportion of businesses who are telling us that they're not actually sure how long their cash reserves will last. And I think there's a couple of conclusions that we can draw from that. The first perhaps is uncertainty that businesses have about their costs. So businesses may not know exactly how their cost profile will change, for example, as they have to perhaps hire a cleaning firm to work throughout the day now, so they can constantly make sure that door handles and other surfaces that people come with are constantly cleaned. But also uncertainty around future revenues and future cash flows to the business, as firms aren't yet clear on what levels of activity they're going to see in the months ahead as the lockdown begins to ease. So a lot of uncertainty there on the business side about what their future cash flow looks like, but not a lot of cash reserves held by a large number of firms. If we move on to the next slide, then we can see some of the trends of UK consumer confidence over the last year or so. And perhaps unsurprisingly, given the lockdown, we've seen a large fall across the UK. And in fact, they're just marginally above the levels that they were at during the financial crisis in 2008. And even though we've seen some tentative signs of the lockdown beginning to be gradually unwound, confidence levels have stayed very low and have actually softened further in the most recent survey of this data. And confidence is going to be a very important factor in terms of the economic recovery, which we'll move on to shortly. But if we move to the next slide, we can start to see some of that evidence that the lockdown is starting to lift and businesses are beginning to think about reopening. Now, whenever the ONS ran this survey in the first part of May, it's possible that since that's taken place, some of these businesses may actually have already started to trade. But if we look across firms who have been asked about when they intended to start trading, we can see a relatively high proportion of manufacturing and construction firms relative to other industries felt they'd be able to get up and running again within the next 2 weeks. And that's perhaps unsurprising, given that these are businesses where social distancing is more possible. So on construction sites, it's perhaps easier for some people to remain the 2 metre distance apart, at least in certain aspects of the work. The same can be true of manufacturing, where there perhaps are larger factories where people can be spread out more, or people can adapt to a shift working type of approach as opposed to the standard 9 to 5. And even for retail trade, we know there's lots of examples of big out of town, large car parking areas which have very customers who come into the store and which have quite big areas in which customers can shop and work their way around shops. So those are some areas that we've seen starting to open up. But the likes of those leisure businesses are the ones that think it's going to be perhaps more than 4 weeks' time before they can start to trade again. And that's really because it's more difficult for them to keep people at a 2 metre distance. And so they would need to perhaps spend more time thinking about how they're going to do that, but also allow for lockdown measures to have gradually eased some more before they can begin to trade again. Now that gives us perhaps a bit of a flavour of businesses in the UK and their domestic activities. If we move to the next slide, what it shows us is shipping activity in the UK. And over the last perhaps 2 to 3 weeks, an upward trend in the number of ship visits coming into the United Kingdom. And I think what this suggests to us is that we're starting to see more international goods trade. So exports are starting to increase, imports are starting to increase. Again, that's encouraging to us as we start to think about firms opening up again and beginning to reintegrate into the global economy, both in terms of getting their supply chains operational, but in terms of where they sell to as well. Now, if we move to the next slide, it gives us some indication of the factors that are likely to impact the economy in 2020 and indeed into 2021. And our expectation for the UK is that the negative economic shock of the virus will be concentrated in the first half of this year, and that the recovery will begin from the second half of 2020. And there's a few points that I would pull out which I think are going to impact those two phases of the economic impacts of COVID-19. In terms of what's likely to underpin fall in output, we're going to see lower spending by households. So partly as a result of people not actually being able to physically go to the areas where they would spend money, like shops, like restaurants, like hotels, but also a function of those lower confidence levels that we've talked about. We also think that drop in business investment as firms focus more on managing through this period of uncertainty. And indeed, whenever economic uncertainty is high, we typically see much lower levels of business investment. And that's something we've seen in the UK over the last couple of years as a result of the Brexit process. And we also think we're going to see lower working hours in the economy. So this will be for a number of reasons. We'll have businesses which have closed and therefore people won't actually be working and will be on furlough. We've seen other businesses keep people actually in work but reduce the amount of hours that each member of staff's currently working to try and keep people in jobs. The closure of schools has likely meant that some people have had to adjust the amount of time that they work so they can balance childcare. And of course, there will be people who are self-isolating because they're displaying symptoms of the virus. And those factors together will contribute to less working hours in the economy and less output being produced. And look to the expected recovery in the second half of this year. We think that the unprecedented levels of government support will provide a base on which the economy can get moving again. So the furlough scheme seems to have been reasonably successful so far at protecting employment. And the hope there is that as firms begin to open, they're able to bring those workers back into the business relatively quickly without having to go through the time-consuming process of making people redundant and then launching new recruitment process that we would have seen in previous recessions. And we've also seen support mechanisms for the self-employed and for hospitality industries and different measures around the devolved regions of the UK as well. We've seen action from the bank, interest rate cuts and other measures to try and support the economy and facilitate a return to growth once activity starts to begin. And those government measures and central bank measures should support the recovery. But I think one factor that will constrain it is changes that we're going to see in business behaviours. And this is where I'll link back to perhaps the cash reserves and the consumer confidence that we touched on. As we come into the recovery phase here, I think consumers will have almost two confidence aspects playing on their behaviour. One is how willing people will actually be to go back to high streets and to crowded areas where they would spend money. So will people be prepared to go back into those areas, or if they see a risk of contracting the virus, will they perhaps be a bit more cautious? And then there's also people's spending decisions. With such uncertainty around not just the virus, but Brexit and what's going to happen at the end of October when the furlough scheme concludes, people may decide to just build up savings rather than spend even once the lockdown begins to be lifted. Given consumer spending makes up just under 2/3 of the UK economy, this is going to be an important factor in assessing the bounce back or the bounce that we'll see in activity coming off the back of this crisis. On the business side, we've seen a number of firms reporting that they have relatively low levels of cash reserves. And so what we may see again with that uncertainty is firms deciding that they want to build those cash reserves up a bit further in case they do close, either as a result of another lockdown, if that were to be the case, or if a number of their staff were to be off and they had to close on a temporary basis, that they would have the necessary cash to see them through that. It's also possible that firms will be a bit more reticent to consider those sort of strategic investment decisions that they might have done previously while the world adapts to a post-COVID landscape. And those factors, I think, are likely to limit the extent to which the economy is back from this crisis. Moving on to the second chart then shows our forecasts, and our most recent forecasts are from April for the UK economy. What we forecasted at the end, about 6 or 7 weeks ago, was a 7% fall in GDP UK year by a 5% increase in 2021. And looking at some of the latest data, it's possible that we'll actually revise our 2020 number down somewhat when we re-review these numbers at the end of this month. But I think the broad path that I've outlined in the chart here is still appropriate and still fitting to the current environment. And what that really shows us is that we don't expect the level of output in the economy to return to its pre-coronavirus level until either late in 2022 or into 2023. And that's partly because of those more cautious and business and consumer behaviours that we're likely to see. And of course, there's the uncertainty that Brexit brings into that as well. So this path would suggest that a Brexit, and would assume Brexit is actually agreed, but some uncertainty may impact again the pace at which we come back in the second half of this year, perhaps the other economies. The next again just sets out some of the key risks around this growth profile. Obviously, there's the pandemic at the minute and the potential for a second wave, for an extension of the lockdown measures, for perhaps a lockdown measures coming into place at another stage if we see a second or third wave. There's also the chance that those cautious consumer and business behaviours are even more extreme than what we've already assumed, and therefore we see less of a recovery in consumer spending and business investment. The global nature of this pandemic means that we global risk recession, which would have impacts on the UK as a relatively large trading nation. That if we saw disruption in other countries around the world, might that have supply chain impacts for UK businesses or reduce demand in some of those international markets where firms in the UK currently sell to? And then, of course, there's Brexit. And if we move to the next slide, then I'll just conclude with a few on the Brexit process. The Brexit transition in which we're currently in is to conclude at the end of this year. And perhaps the next key date in the process for us is actually the end of this month, which is when the UK government must decide if they wish to extend the transition period for a period of 1 or 2 years. As Kristen has mentioned, it looks quite unlikely that the UK are going to do that. The coronavirus pandemic would have been a reason, I think a very justifiable reason, for asking for an extension to the process, as government and political priorities shifted in both the UK and Europe to dealing with the pandemic. The UK have been adamant that the transition period will come at the end of this year. Now, it means that some of the areas on which there are disagreements at the minute include the likes of level playing fields. So this is the extent to which the UK would continue to closely align with EU rules on state aid, on workers' rights, and on environmental standards. UK fishing waters is also something which is pretty difficult to work through. And what this does signal to us is that there is a risk of a no-trade deal Brexit at the end of this year. Now, I think what's important to note is that this is a political negotiation. And so quite often these will run until later in the day before we see an actual breakthrough. And there is an element for both sides of having to appear relatively fair view to their respective electorates or other representatives or other stakeholders in the Brexit process. So it is possible that as we move into the second half of this year, that we see a bit more flexibility from both the UK government and the EU in terms of trying to get a deal. And I do believe that both sides do want to get a deal. Certainly, given the extent of the coronavirus pandemic, I don't think that policymakers in the UK or Europe want to have to manage a disorderly and disruptive no-trade deal Brexit from the start of 2021 as well. But that risk of a no-trade deal is very one. And so I think businesses across the UK who are currently facing uncertainty, but there is a need now to make decisions for Brexit. And that's going to be much more difficult as firms try to manage through the impacts of the coronavirus pandemic and adjust their businesses to what the next phase of their economic growth path looks like, and to adapt to new hygiene and new health and safety requirements and to new consumer behaviours. But time is running out and Brexit is still a live issue. So it is important that firms, while they have limited bandwidth at this time, use what resources they can, start thinking about Brexit again, and make sure they're as prepared as they can be for the 1st of January 2021. With that, I'll conclude, and thank you very much, everybody.
Thank you very much, Conor. Very insightful. We have had a lot of questions. I'm slightly aware of that. We have also hit our end of time. Would the panel be all right for a few more minutes to answer a few questions? Maybe a nod from your respective cameras that I can see. So let's just take 5 minutes and try to get as many questions as possible. So if you can, short answers back, and unmute you as you can. So we had one here from Marcus Postings. Can you give your view of the performance of the construction sector and outlook for the coming period? Would that be you, Conor?
Yeah, so I think certainly, if I think of some of the modelling that we've done for Northern Ireland, what we would see is effectively all sectors of the economy experience attraction and activity in 2020, with the exception of the health and social care sector. So I do think that over 2020 as a whole, we'll see construction activity significantly reduced to what it was in 2019. But like all sectors, as we come into 2021 and businesses start to adapt, I think we would see relatively strong rates of growth compared to what we would have seen or what we would have considered a healthy rate of growth in the past. So I think it's going to be a broadly similar path to what I've outlined there. There will be a big fall in activity in the first half of this year, but I do think we'll start to see a recovery from the second half of this year onwards. But so much is going to depend, construction and perhaps manufacturing as well, that can be thought of as investment-oriented sectors. A lot will depend there on the extent to which we see appetite from the private sector for investment, but also perhaps public sector investment in terms of transport infrastructure or perhaps housing, if we do see a large government fiscal stimulus package at some stage this year. So I think those are some of the things to look out for in the outlook for the construction sector over the next 6 to 12 months.
Thank you, Conor. Then we had a question from Stein, Andre Riedel. You may already have answered this, Alan, but let me just repeat. What are your views on the US recovery given the latest unemployment report, etc.? Have they now reached a turning point post-COVID-19, or is it too early to say? Would that be you, Alan?
Sure, I can answer that. I mean, we have definitely been positively surprised by the unemployment numbers, but also some other data. And I think if we look at some of the economies that have that actually consumers are getting back spending quite fast, and maybe that's also what's reflected in these US numbers. I mean, we did see a very, very sharp rise in unemployment, but it's encouraging to see that we actually now see already that it's coming down again. So I do think that it gives some optimism.
Thank you. If Christina or Conor want to comment on it, you just open the microphone and say so. Moving on to the next question from Morten Ries. UK talking of reducing dependence on China goods. Can you see this growing as a policy for UK/US? Anyone wants to give that a go?
I can at least give it a go. I mean, I do think that what we're going to see is, in general, more move towards more independence of China, also in Europe, especially within certain types of goods. But in general, I think what the experience has been over the past couple of years is that Europe have found out they're very dependent on the US. So I think that's also maybe some search towards trying to find out how can we be less dependent, but definitely also on towards China. There are certain areas, not least within technology and also medical equipment and stuff like that, where I do think that the UK will also be looking at trying to reduce dependency on China.
Cool, thank you. I think two more questions, then we'll call it the day. I have one here for Christine. Christine, in the wake of the recent US riots, do you still see a strong dollar as the US restores first order, then financial growth? I presume it is.
I think for now, at least, it's interesting how little any political tensions flare up that goes both with towards China, but also the internal issue around the Black Lives Matter demonstrations, that it has actually not been a factor very much for the currency markets. I think to the extent that it should become a factor, it will have to impact the presidential election campaigning. And I guess if anything, where we see the key risk is, as Alan mentioned, that we will see more China bashing. And I think where I really see the US politics could start to have an impact on the dollar is that if we are starting to see tariffs being used as a weapon again. So I'm not sure if it's an answer to the question really, but that's really where my focus would be from a market point of view. And in terms of financial order, I guess that question also reaches into the dominance of the dollar and so on, and then that is a very slow-moving factor. The dollar is still very important for the global financial system, for trade and so on. And that is also why you can say many people are calling for a weaker dollar, because maybe that's basically what the world needs to recover here. Question is, of course, whether the Fed will allow it, as I was alluding to earlier, by creating inflation. And we still have some question marks around that.
Okay, so something to follow. One final quick question that's probably for you, Connor. Can you see more business acquisitions to ride the corona wave, as only large firms will survive in the longer term? Would you want to give that a go, Connor?
Yeah, so it is possible that we do see that, and we see more business acquisitions and business mergers as a result of coming through this. I think so much of it is going to depend just on to when activity does start to return and recover. And if we see a period of time in which businesses are struggling in terms of their viability, but had a previously viable business, that if they were part of a larger group that might be able to help on cost sides, then we might see more activity there. But I think at this stage, so much of it still depends on the events to come over the next 6 or 12 months, not just in terms of healthcare development and policy. The economy responds. But it is certainly something that we could see.
Very good. I think we need to move on. There's a lot of work days ahead of us. Just a few comments here. If you haven't noticed already, Christine Tuxen, she actually pasted in the chat line the latest Brexit monitor and a link to their research that you may want to use and have a further read on. Some of you may have noticed already there was also and still is a delegate list downloadable in the upper right corner. You can download and see who attended this webinar today. But for now, let me end up here and say thank you very much to Christine, Connor, and Alan for your expertise, insights, very informative. There's for sure a lot more to follow here and continue. So 3 of you, thank you very much. Also, thank you very much to Danske Bank, of course, to let us have such a panel of speakers presented here today for an audience that basically span most of Europe, I can see from now. So with this, the recording, as mentioned, will be for you to share, to see again in a couple of hours' time. Keep an eye out for your emails. If you didn't get an email in the 2-3 hours' time, reach out to one of your respective chambers. And with that, I really like to say on behalf of the Norwegian British Chamber of Commerce, Finnish British Chamber of Commerce, British Icelandic Chamber of Commerce, and the Danish-UK Association, thank you very much for tuning in. And I wish you all a good day. Thank you all, and goodbye.
Thank you. Bye.
Thank you. Bye.
Thank you, everyone. Bye.